Exercise 816 is a long problem, but let's do this piece by piece and we'll be fine, okay? First it says, this is exercise 816, part 1. It says, journalize these entries. We can do that. So they sold gift cards for $8,000, so that's a debit to cash of $8,000, a credit to deferred revenue. We also refer to that as unearned revenue of $8,000. Then they purchased some additional inventory. This is a fireworks company. They must keep perpetual records, but even if you didn't know the law, you see that they're going to an inventory account, so that means it has to be perpetual inventory. If it were periodic, that would simply be called purchases. So they purchase inventory for $147,000. And those purchases are on account, so that's a credit to accounts payable of $147,000. Then on January 15th, we record our sales for the first half of the month. All of those sales are on account, so that's $135,000. So we debit our accounts receivable, $135,000. And we credit our sales revenue, $135,000. But remember, this is perpetual inventory, so we have to handle the cost of goods sold as well. And they tell us that the units sold cost us $73,800, so that's a debit to cost of goods sold, $73,800, and a credit to inventory, a reduction of our inventory of $73,800. Then on January 23rd, we receive $125,400 from our customers on account, $125,400 cash, $125,400 a debit to our credit to our accounts receivable. That's the asset shift we did a lot of early on. Then on January 25th, we pay $90,000 to our suppliers. So we're paying off some of this. So we're going to debit our accounts payable, $90,000, and of course we're going to credit cash, $90,000. Credit cash, $90,000. Now, on January 28th, they tell us we're going to write off accounts receivable as uncollectible for $4,800. And we don't have to do any calculation, they just give us that number. So we're going to write off allowance for doubtful accounts, $4,800, credit accounts receivable, $4,800. So on accounts receivable, it looks just like we got paid, except we didn't, okay? Then on January 30th, we recorded our sales for the second half of the month for $143,000, and some of that was in cash, some of it was in accounts receivable, and all of it was revenue, so we have to handle that. So we have cash, they tell us was $11,000. So that's a debit to cash for $11,000. It's a credit, it's a debit to accounts receivable of $132,000 and a credit to sales revenue for the total of $143,000. But keep in mind, we use perpetual inventory, so we have to also record the reduction of the inventory. We have to keep track of that. So they tell us that the cost of goods sold was $79,500. That's what we paid for it. So that's a debit to cost of goods sold, $79,500, and we reduced our inventory, credit our inventory by $79,500. $500. The last thing we have is we're going to pay our salaries for the month. We're just paying the people that worked in our highly explosive warehouse, and we're going to pay them $52,000. That's salary expense, and we pay them in cash or check, and that's $52,000. So that's the transactions for the month of January. Seemed like a lot more work than it actually was. Not so bad.